Welcome back. We need to talk. Right now. While you were sleeping, while the Western markets were closed, while the financial media was busy discussing earnings reports and tech valuations, something broke in Tokyo. Something so massive, so structural, and so terrifying that it makes every other financial story this year look like a footnote. The Bank of Japan is meeting right now. As you watch this video, central bankers in Tokyo are sitting around a table deciding the fate of the global financial system. And based on everything we are seeing in the data, they are about to trigger a $1.2 trillion liquidation event that will hit American markets within 24 hours. This is not speculation. This is not a theory. The yields on Japanese government bonds have just hit levels not seen in over 2 decades. The 40-year yield has crossed 4%. The 30-year is at 3.9%. The 20-year is at 3.47%, and the 10-year has hit 2.34%. If you live in the United States, you might look at those numbers and think, so what? Our rates are higher than that. But you have to understand the context. For 30 years, Japan has been the land of zero interest rates. For 30 years, the Bank of Japan pinned rates to the floor to keep their zombie economy alive. A 10-year yield of 2.34% in Japan is not just high. It is an economic heart attack. It means the cost of servicing their massive national debt has just tripled overnight. And here is what makes this your problem. Japan holds $1.2 trillion of United States Treasury bonds. They hold approximately $500 billion of United States equities. They own Apple. They own Microsoft. They own Nvidia. They own the same stocks sitting in your retirement account right now. And in the next 24 hours, they are going to start selling. Not because they want to, because they have to. The Bank of Japan meeting concludes tomorrow morning, Tokyo time. That is tonight for us on the East Coast. And the smart money is already positioning for what comes next. Governor Kazuo Ueda has made his intentions clear. In a speech just weeks ago, he stated explicitly that the Bank of Japan intends to keep raising interest rates. The market is pricing in a 74% probability that they hold rates steady this meeting, but they are expected to signal more hikes coming in February or March. And here is the trap. Every time Japanese rates rise, it creates a giant sucking sound. Trillions of dollars of liquidity being pulled out of global markets and rushing back into Japan. We call this the Great Repatriation. And it is the trigger for a global margin call. Think about this from the perspective of a Japanese pension fund manager. For 20 years, you could not get any return on your money at home. Japanese bonds paid zero, so you sent your money overseas. You bought American treasuries yielding 4%. You bought American tech stocks that went up 30% a year. But now the dynamic has flipped. Now you can get 4% at home in your own currency without the exchange rate risk. Why would you keep your money in America when you can bring it home and earn the same return in yen? You would not. So you sell. And when Japan sells, the entire global financial system trembles. Let me give you the numbers that Wall Street does not want you to see. Japan is the largest foreign holder of United States government debt. As of November, Japanese entities held $1.2 trillion in US Treasury securities. That is more than China. That is more than the United Kingdom. That is more than any other country on earth. And that money is about to start flowing the other direction. But it is not just the treasuries. The Government Pension Investment Fund of Japan, the GPIF, is the largest pension fund in the world. They manage over $2 trillion in assets, and a massive chunk of that is allocated to foreign equities. American tech stocks, the same stocks that make up the backbone of the S&P 500. When the value of their Japanese bond portfolio crashes, and remember, when yields go up, bond prices go down, they face a solvency hole. Pension funds have liabilities. They have to pay retirees every month. If their safe assets lose value, they are forced to sell their risk assets to raise cash. This is not a choice. It is a mandate. It is forced selling. And based on the data we are analyzing, they will not dump it all at once. That would be too catastrophic. Instead, they will sell slowly, methodically, day after day, for the next 12 to 24 months. This creates a permanent headwind for the stock market. Every time the S&P 500 tries to rally, a Japanese pension fund will step in and hit the sell button. It is like trying to swim upstream against a relentless current. The smart money sees this. That is why US Treasury yields have been spiking alongside Japanese yields. The 10-year US yield is hovering around 4.2%. The 30-year touched 5%. And if Japan starts dumping their $1.2 trillion stockpile onto the market, those yields could spike to 5%, 6%, maybe even 7% overnight. This is the financial heart attack. If the 10-year yield hits 6%, the US economy stops functioning. Mortgage rates would go to 10%. The housing market would freeze. Auto loans would hit 12%. The car industry would collapse. Corporate debt would become unserviceable. Massive bankruptcies would follow. But the most dangerous consequence is for the United States government itself. At current rates, the interest on the national debt is already over $1 trillion a year. We now spend more on interest payments than we spend on our entire military. The national debt has ballooned to $38 trillion. We are running deficits of $2 trillion a year. We need to sell billions of dollars of new debt every single day just to keep the lights on in Washington. If rates double because Japan walks away, the interest payments would jump to $2 trillion. The United States would be mathematically insolvent. No politician will allow that to happen. So what is the solution? What happens when the buyer of last resort leaves the building? A new buyer must be created, and there is only one entity with the power to do it, the Federal Reserve. This is the trap. The Federal Reserve knows that if Japan sells, they have to buy. They cannot let yields spike. They cannot let the auction fail. So they will restart the printing press. In fact, they have already started. Just last month, the Federal Reserve officially ended quantitative tightening. They removed $2.5 trillion from their balance sheet over the past few years, but now they have reversed course. They are now purchasing approximately $45 billion in securities per month under what they call reserve management purchases. They will not call it quantitative easing because that sounds inflationary. They will call it market stabilization or liquidity support. But the mechanics are the same. The Federal Reserve will create trillions of new dollars out of thin air. They will use those dollars to buy the Treasury bonds that Japan is selling. They will monetize the debt. This is the final stage of a dying currency. It is the moment when the government stops borrowing money from the world and starts borrowing money from its own printer. It is exactly what happened in Weimar Germany. It is exactly what happened in Zimbabwe. When you monetize the debt, you solve the liquidity crisis, but you create a currency crisis. You save the bond market, but you kill the dollar. This brings us to silver. Why is silver trading near $94? Why has silver surged 15% in just 1 week? Why has gold pushed past $4,600? Because the smart money sees what is happening in Tokyo. They know that the only solution to a sovereign debt crisis is currency debasement. They are not buying silver because they like solar panels. They are buying silver because they are fleeing the bond market. They are running away from the widowmaker trade. The Japanese bond market is called the widowmaker because for 30 years, traders who bet against it lost everything. The Bank of Japan always stepped in. They always printed more money. They always bought more bonds. But now the Bank of Japan has stopped buying. They are letting rates rise. They chose to save the currency instead of saving the bond market. And in doing so, they just blew up the global cost of capital. Let me explain the yen carry trade because this is the mechanism that is about to detonate across global markets. For years, hedge funds borrowed money in yen at 0% interest. They converted those yen to dollars, and they used that money to buy Nvidia, to buy Bitcoin, to buy real estate, to buy anything with a higher return than zero. This is the famous carry trade. It is essentially free money. Borrow at zero, invest at 5%, pocket the difference. But now the yen is getting expensive. Japanese rates are rising. The cost of borrowing has skyrocketed, and the yen has been strengthening against the dollar as repatriation flows accelerate. So what do the traders have to do? They have to pay back the loan, and to pay back the loan, they have to sell the asset. They have to sell the Nvidia. They have to sell the Bitcoin. They have to sell the real estate. This creates a feedback loop from hell. Japan sells assets. Yen goes up. Hedge funds blow up. Hedge funds sell more assets. Market crashes further. It is a self-reinforcing cycle of liquidation, and once it starts, it is very hard to stop. We saw a preview of this in August. The most dramatic carry trade unwind happened not in emerging market currencies, but in US momentum stocks. Japanese investors sold their most appreciated assets first. The Magnificent Seven got hit. And analysts are warning that if the yen trend has fundamentally shifted, Japanese investors may eventually sell their US bonds in favor of Japanese bonds. That would be the nuclear scenario. The $500 billion in equities is just the tip of the iceberg. The $1.2 trillion in treasuries is the real weapon. And that weapon is being loaded right now in Tokyo. You have 24 hours. The Bank of Japan meeting concludes tomorrow. If they signal more rate hikes, if they adjust their yield curve control policy, if they do anything that causes Japanese yields to spike further, the repatriation accelerates. The carry trade unwind accelerates. The selling begins. This is why I am telling you this now. Not tomorrow, not next week. Now. Because by the time the mainstream media covers this story, by the time CNBC runs a segment on Japanese bond yields, by the time your financial advisor returns your call, the move will have already happened. The smart money will have already repositioned, and you will be left holding the bag. The data we are analyzing suggests the world is entering a rate environment that no one alive has traded before. We have never seen a world where Japan is a net seller of global assets. For our entire investing lives, they have been a net buyer. The flow of the river has reversed, and this reversal affects everything. It affects mortgage rates in the US. It affects the price of gold. It affects the stability of the euro. But the biggest victim will be the US Treasury market. Japan was the last man standing. They were the backstop. Russia sold everything years ago. They are out. China is actively selling to buy gold and copper. They are out. Saudi Arabia is moving away from the petrodollar. They are out. Japan was the loyal customer, the most reliable buyer the United States Treasury ever had. And now they are walking away from the table. Who replaces them? The Fed? We know that leads to inflation. That leads to dollar debasement. That leads to exactly what we are seeing in the precious metals market right now. Silver hitting levels we have not seen in decades. Gold pushing toward $5,000. Hard assets becoming the only safe haven in a world where paper currencies are being printed into oblivion. This is the wealth transfer event. It is not a prediction. It is a mathematical inevitability. When the Fed prints $3 trillion to buy the bonds Japan is dumping, where does that money go? It goes into the system. It dilutes every dollar in your savings account. It destroys your purchasing power. And the people who saw it coming, the people who moved from paper assets to real assets, they will be the beneficiaries of that transfer. This is why silver is not just going up. It is repricing reality. The paper price you see on your screen is a legacy number. The physical market, the real market where actual metal changes hands, is already pricing in what comes next. Dealers are widening spreads, premiums are rising. The smart money in India has imported $6 billion of physical silver in just 4 months. China is paying $105 per ounce in Shanghai, while New York pretends the price is $94. The arbitrage is breaking down. The paper market and the physical market are diverging. And when that divergence becomes undeniable, when the COMEX cannot deliver the metal that has been promised, the price will gap up overnight. We are watching the first domino fall right now in Tokyo. The second domino is the Japanese bond market. The third domino is the US stock market. And the final domino is the US dollar itself. Because when the dust settles and the selling stops, the only way the system survives is if the Federal Reserve prints enough money to buy everything Japan is selling. They will have to monetize the entire debt stack. Your portfolio is the arm that is about to be severed. Japan is cutting off the arm to save the body. The arm is American assets. The body is the Japanese financial system. And you, the American investor, are sitting right on the arm. The phone is ringing. Japan is on the line. And they are asking for their money back. You have 24 hours to decide which side of this trade you want to be on. The side that is printing money into oblivion, or the side that is accumulating the only assets that cannot be debased. The metals that have stored value for 5,000 years. The hard assets that have no counterparty risk. Every basis point rise in Tokyo brings us one step closer to the restart of quantitative easing in Washington. And every dollar printed in Washington brings us one step closer to triple-digit silver. The Widowmaker has snapped. The global margin call has been issued. Japan is going home. Are you prepared for what happens when they hang up? If this video helped you understand what is really happening in the global financial system, drop a comment below. Let us know you're part of the community that sees through the noise. Share this video with someone who needs to hear it before tomorrow morning. Because when the sun rises over Tokyo, the world changes, and you want to be positioned before it does. We will be here tracking every ounce, every yield, and every dollar printed. Stay sharp. Trust the math. The signal has been sent. The countdown has begun.